Imagine your organization was offered a donated piece of land. Sounds great? What if after you accepted it, you found out that there were environmental issues, unpaid real estate taxes, a structure on the land that was a historical landmark, and the building needed significant repairs? Would you have accepted it then? Today, we'll talk about how to protect your organization from this and other scenarios. In a few of my earlier episodes, I discussed the need to develop a gift acceptance policy. Today, I'm going to go into the details of what that policy should look like, what boards and management should consider now so that they don't get into trouble later. Hi, I'm Joe Blatt, and this is Joe Talks Nonprofits. Over my career in public accounting, I've seen clients make some pretty big mistakes when it came to accepting and soliciting gifts. These mistakes not only cost you time and money when you make them, but can cost you time and money for years to come. In this episode, we'll go through some areas you should cover in your organization's gift acceptance policy, including how to handle non-traditional gifts such as land, cars, property, and endowments, and who should be involved in the acceptance process. Let's start with what a gift acceptance policy actually is. This is a policy all nonprofit organizations should have. It's even a question in your organization's 990 as part of Schedule M. Even the IRS understands that if you're accepting non-cash contributions, you need to have a process on how to accept them. When you think about how to structure a gift acceptance policy, it should be broken out into distinct sections based on the type of gift we are accepting. The closer to cash the item is, the lower the general risk to the organization. So, for example, accepting publicly traded securities would be different than accepting a used car or a used boat. In this session, we will break out the discussion by section, starting with the easiest and working our way to the more complex areas as we progress. The first part of the gift acceptance policy should be general. It should include a statement that the organization will only accept gifts that support its mission and will not create reputational risk or operational harm. Gifts for programs outside of our mission may result in unrelated business income tax or jeopardize our tax exempt status. It should define the categories that will be covered in the policy, including cash, marketable securities, real property, cryptocurrency, art, and any other area you decide require a separate mention. Also, if there are specific items we don't want to accept, we should define them as well. Governance policy should also be defined here. So if we decide we need to set up a gift acceptance committee, defining who's part of that committee early on will help us in not having to repeat that several times as we go through our policy. The committee should generally include key members of management, your fundraising director, some members of the board of directors, and in some case, in-house counsel. The policy should define what we will consider to be a restricted gift, including purpose restrictions as well as time restricted gifts and endowments. Accepting a $5,000 restricted gift for an ongoing program is very different than accepting one for a program we didn't start yet, or a gift to establish an endowment. Each of these should have different levels of approvals within our policy. Similarly, conditional contributions should be defined here as well. After our definitions are complete, we should address compliance and IRS guidelines. Certain non-cash contributions we receive will require the organization to sign an IRS Form 8283 given to us by the donor. We should define who can sign this form on behalf of the organization. The signer is not only acknowledging receipt of the item, but also acknowledging responsibility on behalf of the organization to notify the IRS if we sell the asset within 3 years of receipt. The form also asks if the donor required the donation to be held for 3 years or longer. Signing the form sets off a compliance clock that the organization needs to maintain for the next 3 years to monitor that donated asset. If the asset is sold, the organization must file an 8282 with the IRS and send a copy as well to the donor. Our policy should clearly define who will be responsible for this task, include who will be responsible for filing the form. I did a separate episode on non cash contributions that can provide more context here. If you're interested, I'll add a link in this video to that episode. Part of our compliance program should also address acknowledgement letters to our donors. We have a requirement to acknowledge gifts we receive from donors. Donors need this acknowledgement to be able to take a deduction on their annual tax return. The acknowledgement letter will differ for cash contributions and non cash contributions, and will also be different for quid pro quo type transactions, such as a ticket to an annual gala. Who prepares these letters, what they say in the letter, and who will sign them should be defined in our policy. When we acknowledge receipt of non cash contributions, we need to be careful. We need to be clear in our policy that we will not value the items donated, and we will only thank the donor for the donated item. The letter should also clearly describe the items being donated, state that no goods or services were received by the donor in exchange for their donation, including a statement that the organization is a 501c3 organization, and include the date of the donation. For quid pro quo donations, we need to determine the fair value of what the donor received and exclude that portion from what is tax deductible by the donor. This may be a statement such as, "Thank you for your donation of $100 to our organization. $60 of your donation is tax deductible." Failure to specify the deductible component may result in an IRS penalty for each acknowledgement letter sent out. So getting this right is important, both from a compliance perspective as well as a donor relation perspective. IRS publication 1771 is a good tool of reference that you can use and reference as part of your policy. Cash is the easiest type of gift to accept. We should define cash to include checks, credit cards, and other such items. Our policy on accepting these types of gifts should be simple and not have too much of a review process unless they're accompanied by restrictions or conditions. Securities should be broken out into those that are publicly traded and available for immediate sale from those that are not. I've had clients receive restricted stock that were locked up for several years and hard to value. These types of donations need to have more stringent review process before we can accept them. Similarly, shares in corporations, partnerships may bring unnecessary liability to the organization. For publicly traded securities, I generally recommend to my clients to have a sell upon receipt policy. Most brokers will set up a separate investment account for you that your organization can use solely for these types of transactions. The broker knows to sell any securities that are deposited into this account. As an organization, you want your investment committee to determine how to invest your funds and not have it determined by random donations. Real estate is also a common item I've seen my clients receive. Those usually come in through bequests. Most real estate can be sold upon receipt, with the proceeds going to fund the mission of the organization. Due to the value and complexities that come with real estate, I generally recommend doing some due diligence before accepting it. I have seen properties donated that were overseas and required the organization to expend substantial funds to sell and transfer these funds back to the United States. Properties can also have environmental issues that could cost your organization a lot of money to correct, or unpaid real estate taxes that your organization will be on the hook for. Doing some due diligence here before accepting the donation is important, and having either the board of directors or a gift acceptance committee review the transaction is a good idea as well. If the real estate can't be sold because it may have an easement running through it, or the donor made a request that this property be used by the organization for programmatic purposes, this too would require additional scrutiny by the board. Accepting this property will require us to bear the cost of the annual maintenance of the property and we may need to do that in perpetuity. Budgeting out these costs before accepting the donation is important. Cryptocurrency is another area your organization should address in your policy. Even if you've never received a cryptocurrency gift, you should still determine what you will do if and when this happens. Many donors have substantial unrealized gains in their cryptocurrency accounts and may wish to benefit from the tax advantage of donating these items as opposed to donating cash. Having a process in place on how to accept them is important. Not having a policy may mean that someone at your organization may tell the prospective donor that they can't donate their Bitcoins to your organization, and you may lose a substantial donation and impact your relationship with your donors. Other items not included earlier may be put into one large category, including cars, boats, artwork, and other tangible assets. These items should be further divided up into those that we can sell immediately from those that we can't. For example, if someone donates to us a Picasso painting worth $50,000 and says you need to hold it for 3 years, who's going to pay for the storage, the insurance, and the other costs we incur over that 3-year period? If the art needs to be held in perpetuity and displayed at your programmatic space, what are the annual carrying costs? Will it be at risk for theft or destruction? What if we receive a donation of a used computer or a piano? Do we have a need for these assets, or are we going to dispose of them? If we plan on disposing of them, do we have a mechanism to do so? I had a client who received a donated horse. The horse was old and required veterinary assistance, a barn, food, and daily care. What seemed like a nice gesture was a huge burden on the organization. All this needs to be weighed by a gift acceptance committee before saying yes. Not all gifts are good gifts, or more precisely, not all gifts are good gifts for our organization. Another area many organizations forget is planned giving. Planned giving includes everything from bequests to beneficiary designations on retirement accounts, life insurance policies, and other investment accounts. It also includes some complex items such as charitable gift annuities, charitable remainder trusts, and charitable lead trusts, as well as pooled income funds. These gifts may not be realized for years after they are set up. How to record them, track them, and account for them over this time should be addressed in our policy. I've had clients forget that they were beneficiaries in these accounts, and in some cases, they lost their rights over time. Some of these are also insurance products and involve risk, actuarial calculations, and government regulatory requirements and annual reporting that we as a nonprofit are required to take on. Not doing so could result in problems with the IRS as well as issues with our donors. Understanding our risks before accepting some of these gifts is important. After you have exhausted the type of assets you may get as a donation, you'll want to devote a section to restricted and conditional contributions. I'd recommend separating these out into at least 3 separate categories. The first being endowments. These are the most restrictive type of gifts. They're permanently restricted contributions. Here you want to set up processes on who can accept these type of funds and what are the minimum gifts we will accept. If you go back to my episodes on endowments, you'll see a lot of good examples and definitions of what these funds are. But for now, if you don't know, an endowment is a contribution that's not fully expendable in the current period. In many cases, the original gift will never be expended. Only a component of the investment return will be used for the intended purpose. So, for example, a $100,000 endowment gift may only yield $4,000 a year for its intended purpose. Having a minimum threshold is crucial because the cost to manage these funds could be a significant burden on management. The second area I would address is restricted contributions for ongoing programs. Those should be easier to accept since we have these programs running and we're planning on spending these funds anyway. The third would be for programs or activities that we don't have in place yet. So this may be the building of a new swimming pool, a capital campaign for a new building, or an expansion of a program to new sites. All of these items come with some level of risk. Where will the balance of funds come from? Is this expansion within our strategic plan? And where will the funding come from to operate the programs that are going to be in these locations? A separate section should address conditional contributions. Here, too, we have a level of risk. What if we don't meet the conditions? If we develop a program and don't meet the conditions, who's going to bear the cost? If a donor pledges to match contributions made for our after school program, will the contributions that we solicit to match these funds get diverted from donors who normally would give us contributions that are unconditional? If the donor required us to bring a minimum of 100 people to a lecture series in order to receive their contribution, where we traditionally only would have had 50 people at in our lecture series, will we actually be able to earn that conditional gift? These are things we need to consider before accepting these contributions. The accounting and bookkeeping for each of these transactions should also be part of our policy. We need to document when and how we will record a contribution into our general ledger. We should address valuation techniques for non-cash contributions. Even though I said earlier we will not value non-cash contributions for purposes of acknowledgement letters to the donors, we do need to value the donations to record them in our general ledger. Some items may be easier than others to value. If we sold the asset upon receipt, we may use the sales price as a means to determine valuation. For other items, we may ask the donor what he or she paid for the item. We may be able to go onto eBay or other third-party sites to look up these similar items if they're used or if they have a retail site and it's new. One last category many forget in their policy is donated services. Since these are not traditional gifts, they may end up getting left out. Here we want to discuss what type of donated services we will accept. We should also clarify the requirements under GAAP when we can recognize these donations in the general ledger. We should clearly state that no acknowledgement letter is needed for tax purposes since donated services is not deductible by the donor. We should also discuss valuation techniques when and if we need to record these in the financial statements. Developing these policies will take time and effort by your fundraising department, administration, and the board. Even if you never received any contributions other than cash or stock, having a gift acceptance policy is important. You don't want to have to second guess your team after they accept or reject the gift from a donor. It will also take a burden off your staff and volunteers when they are faced with a potential donor. They should be able to direct the donor to the right person with very little effort. You might even want to post your gift acceptance policy on your organization's website. From a tax perspective, we should also be very clear in our policy that we will not give donors tax or financial advice. They should consult their own tax advisors. Many fundraisers want to be helpful and can accidentally give inaccurate advice. Also, the donor may ask you to value donated goods, which as the recipient, we're not allowed to do. So as a board member, a few takeaways. Start by asking to read your organization's gift acceptance policy. See if it needs to be updated or expanded. Set up an ad hoc committee to handle this update. Remember, as a board member, you have certain fiduciary responsibilities to the organization to provide structure, reduce risk, ensure compliance, and prevent impulsive decisions. This policy helps check off all of these boxes. If you're a member of management, read through your policy with a fresh set of eyes. Set up a checklist of areas that need updating. Work with your board to update your policy where needed. Develop a checklist staff can use to help them navigate the donation acceptance policy. Add some pro forma acknowledgement letters that meet your approval and provide some education both to your staff and your board once the policy is fully documented. Did you find this episode helpful? Let me know in the comments. If you liked it, please like and subscribe. I will bring new, fresh episodes every Monday. Thanks for joining me on Joe Talks Nonprofits. Please share this episode with a board member or a nonprofit leader who needs to hear it. I'll see you next time. This podcast is intended for general and informational purposes only. It doesn't constitute accounting, tax, or legal advice. Listening to the podcast doesn't create a client advisory relationship. The information discussed may not be applicable to your specific facts or circumstances. You should consult with your own professional advisors before making decisions relating to accounting, tax, legal, or governance matters. Thank you.